For more now on what to expect from the Fed at tomorrow's meeting and the impact on stocks, let's bring in Victoria Green, Chief Investment Officer with G Squared Private Wealth, and Kevin Mon, President and Chief Investment Officer at Henyon and Walsh Asset Management. Welcome to you both. All right, Victoria, what's the setup here? How would you describe it to people?
Well, I think we have to realize they have to go another 25 basis points, especially on the heels of what the ECB did. But they are in a tough spot because I look at this as Maslow's hierarchy of needs. They need to put out the fire first before they can start rebuilding the house. And right now, the banking system hasn't really been quelled. There's been a lot of forceful response from the Fed, both from what Yellen said today. They're trying to do FDIC insurance. But I think we're all going to be looking at what does Powell say? What is the trajectory going forward? Are we going to see cuts like being priced in now? We saw these dramatic shifts in the bond yield curve, as well as future projections on where we go now. So I think it's not less about the 25 basis points. I think it's more about what he says on the trajectory going forward. And is he finally going to back off that hawkishness that he had been, beating the table about?
Victoria, do you think the stock market overall has been somewhat resilient in the wake of everything that's happened here? I mean, look, we were already talking about it year to date. I just checked Tesla. It's still up, I think, 58% this year.
Teflon stock. That is definitely the Teflon stock in the index. But yeah, if you look at what has happened in the last 10 days and you look at the Dow, the Nasdaq, and S&P, you would think that no banks failed and everything was fine. And so, yes, I think maybe a little bit it's that the dog meme where he's drinking coffee and everything's on fire and he's saying everything is fine. A little bit, that's what the market's been doing. But I think it's also looking past some of the crisis. It's saying we have government intervention. There won't be any other failures. And the Fed's about to come off the gas pedal. So a little bit, you are seeing risk on.
So, Kevin, talk to us about what you see the Fed doing and what it will mean for equities throughout the remainder of the year. It feels as though the conventional wisdom is dictating that we are close to the end of this rate hiking cycle, one way or another. It may be a pause tomorrow. It may be all over tomorrow. It may be 25 basis points now and in May again. But talk to me about the impact that potentially the end of the rate hike cycle is close.
Sure, Tyler. And since March of last year, the Fed's primary focus has been on fighting inflation, essentially telling the markets that they were going to continue to raise rates and reduce their balance sheet until something broke. Well, now something has broken. And if there's any silver lining to this banking crisis, it's that it's going to prevent the Fed from being as aggressive as they want to help curb record-setting levels of inflation. So if we expand our investment horizon, Tyler, out over the next 2 years, when rates should be lower, when yields should be lower, when inflation should be lower, and when markets should ultimately be higher, well, there's some very attractive opportunities in the stock market, particularly in sectors that were beaten up in 2022 and should help lead the recovery out of this economic slowdown, which may ultimately lead into a recession. Those areas, of course, are technology, consumer discretionary, and the biotech area of healthcare. We like three names in those areas, Tyler, here at Smart Trust. On the technology front, we like Broadcom. On the consumer discretionary front, we like Dick's Sporting Goods. And finally, on the healthcare area, we like a large cap pharmaceutical name named Regeneron. I think those are the opportunities investors should be
quickly. Is it too early to start if I buy your thesis, is it too early to start accumulating positions in these kinds of shares, or put another way, are you going to have a better price opportunity a few months from now?
Tyler, as you know, trying to time the market is often an exercise in futility. Historically, the stock market generally recovers around 9 to 12 months prior to the economy recovering. That may very well be right now. And these opportunities are trading at attractive multiples, were beaten up over the course of the last year and a half, and I believe will help lead us out of this particular economic slowdown. But now may very well be the right time to consider adding them to your portfolios.
All right. We're a little pressed for time today. We got a packed show. Victoria Green, Kevin Mon, thanks very much. We appreciate it.
My pleasure.